Hey there traders, hope you guys are doing well. So in this video guys, I just want to talk about something super important, and that is the day count, the 3-day count. Because what trading is it's all about stacking the odds in your favor as much as possible, and I'll just explain what I mean now. See, retail traders, when the market starts to push up, they'll immediately go short when they see, for example, bearish candles and expect the market to do this, right? But what you got to understand is the market usually trades in a certain direction for at least 3 days, at least 2 to 3 days. So before I look at counter trending, the minimum I'm looking at the 3-day count. All right, so I've added this. If you go back to my previous video, I showed you these 3, but I'm also looking now as well at the 3-day count. So because to be honest with you guys, I used to counter trend everything that I saw. As soon as the market started to go up on the first day, I'd start counter trending. I'd see bullish candles. Well, if the market was bullish, I'd see bearish candles and stuff like that, and I'd look to go short in this scenario. You know, whether it's a downtrend or an uptrend, but I'm giving you an uptrend example right here, so you can see. Usually, what will happen is, well, what you're supposed to be doing is you actually, if the market is pushing up, in this example, you should actually be looking at hopping on board the trend. So looking at, okay, normally these candles, these reversal candlesticks here are fake candlesticks, and you'd be looking for these fake candlesticks and looking to get on board these moves. But you got to understand the 3-day count. So what I mean is, if you look here, we can see this is day 1, day 2, day 3 of a bearish market. So after day 3, so on day 4, the market starts to trend up. You can see in this example, day 1, day 2, day 3, and then the market starts to reverse. So you must understand that the market usually trends in a certain direction for a minimum of 3 days. You can add this as a rule, as an important rule to your strategy. Before you look at counter trending any market, understand the 3-day count. Okay, so let the market at least trade for 3 days in a certain direction. So you can see over here, we've got day 1, day 2. Now we're waiting for day 3 to happen, and either during day 3, towards the end of day 3, or somewhere in the middle of, somewhere in day 4, the market will look to breathe out, you know, to actually to push back, to pull back a little bit. So, okay, so you got to understand that the market is like a living organism, so that it's just like us. It breathes in and then it breathes out. Okay, so it'll breathe in, then it'll exhale. So you'll see that the market will push up for 3 days. So it'll breathe in and then it'll exhale. The same with this. The market will breathe in, but in a downtrend, and then exhale. So there'll be a profit release. So the point of this video is, don't ever look at counter trending unless you've seen 3 days of trend first. So wait for the market to actually trend first for 3 days before you're looking at counter trending. One way you can do this is by having a moving average. So in this bearish market example, we get day 1, day 2, day 3, and then you see price crosses over the moving average, and then we get a release. So we get the market push up for 3 days. So we get day 1, day 2, day 3. Price crosses below the moving average. Okay, then on that 4th day, price drops. You can see over here, if you're patient enough to wait for something like this. Now this was a 260 point drop. If you don't like to use moving averages, you can use like trend lines. So you could put a trend line or something like that in place. You can see at day 1, day 2, day 3, then as soon as you see price starting to respect or break below the trend line, then you can look to go short. So there's that example. You can see over here, we could just put a trend line in place like this. We could just join the highs like that, so you can see. Let's remove this. So this is just a rough example. You can see day 1, day 2, day 3. Day 1, day 2, day 3. So on the 4th day, you can see this. Also combining it with price action, meaning combining it with, you can see this bullish engulfing candle. So we get day 1, day 2, day 3, and then on the 4th day, Now right at the end of the 4th day, price starts to push up, and you can see this was almost a 500 point move. So just in general, as a rule of thumb, you must incorporate the 3-day count instead of, because what I used to do is, why I used to take a lot of losses, I used to counter trend. I wouldn't look at the higher time frames like the 1 hour, the 4 hour. I'd be so focused on the 15-minute and the lower time frames. And even on the first day, so like on the first day, I'd say now, first day I'd start to counter trend here and get killed. Second day I'd look to counter trend and get killed. Third day sometimes I'd look to counter trend still and get killed. And by the time that happens, you've blown your account. So if you incorporate the 3-day rule, meaning day 1, day 2, day 3, only on the 4th day, because you'll normally get 3 days of a trend and then either a couple of days, either a day or 2 of a breathe out, of a release, of a profit release. So like you can see over here, day 1, day 2, during day 3, the market starts to trend up. We can see over here, we can even start the day from here. So day 1, day 2, day 3. If we had a trend line in place, or if we had a moving average, we can see here. So if you don't like to use the trend line, you can see here day 1, day 2, day 3, and then the price starts to move up. So the point of this video is that so right now we can see who is in the money. We can see buyers are in the money. Where's the liquidity? We can see that, let me just remove this. We can see that all these highs have been taken out. The liquidity has been taken out. So all the sellers are now out of the market. Whoever thought the market was going to carry on dumping, they all out of the market. Okay, where's the price most likely going to react from? We can see there's major imbalance here of this candle. So once this imbalance gets taken out, if you drop down to the 15-minute time frame, you'll see there's actually imbalance. It will end where I put the zone. If you look at a couple of weeks ago, I said that price was actually here, and I said price was going to drop for a certain zone, and I had this zone marked out here somewhere. No, wait, it was down here. If you go back to that video, you'll see I had the zone marked here. And you can see price did actually come to that zone and drop like 200 points from the top here. You could have caught this on the lower time frames, such as the 15-minute. You can see price came into that zone, gave us a tweezer top, and the price melted. So you can see over here my next zone is up here. Just got it marked out up here. I'm expecting the price to react from next. But you can see here we've had day 1, we've had day 2. Now during day 3, we can expect the price to come into the zone, and either at the end of day 3 or at the beginning of day 4, we can look at the price reversing. So the point of this video is never counter trend the market. Always wait for the 3-day count at minimum before looking at counter trending the market, because the market normally breathes in for 3 days at minimum and then releases for 2 or 3 days. So I hope this, because it's all about putting the odds in your favor. It's all about adding these little rules into your trading system so that you don't get caught on the wrong side. Because as I said, the way that I used to lose a lot of money was that I would counter trend the market on day 1 or day 2, sit and draw down or blow the account, and then on day 3, during sometime in day 3, at the end of day 3, the market would reverse, and by that time you've already blown your account or you've taken a huge loss. So I had to learn this lesson, and it's just something that's important to incorporate in your trading. So I hope this video helped, guys. Hope it gave you some thoughts, because the points of my videos are just to give you some thoughts and just to try and improve your trading by adding ideas and different things into your trading in order to help you improve and not over trade and look for high probability trades. But all these little things can help in order for you to be a more successful, consistent trader and get better entries in the markets. Have a good week, guys. Chat soon. We'll chat next week. Peace.